Hey, welcome back to Watch Your Six. I'm your host, Jason Edwards, and it's nice to have you back. I thought we'd take a moment this beginning of our discussion to go into market outlook. We've got a really good topic today. We're going to talk about some of the biggest mistakes entrepreneurs make, but we wanted to maybe go back a little bit and digress and see what's happened the last couple of months and why things have been seeming to be so robust. We've discussed how we felt the market had some opportunities there, and lo and behold, the discussion came to fruition. So let's talk a little bit about the concepts of a bull market and what we think is going on in that marketplace. Again, no guarantee of returns, no guarantee of any kind of yields, but the facts are the facts. So for example, one of the things we saw with this market is the level of resiliency. If you remember in April, the market dropped nearly 20%. And when we say the market, we're using indexes. So market indexes like the S&P and the Dow, these are considered benchmarks. And that traditionally will catalyst a possibility or a discussion of some type of large market correction or depression. But what was ironic about this market is less than 2 months later, the market rebounded more than 20%. That's a huge indication of sustainability. That's a huge indication of potential growth. When you have a market that can rebound that quickly and that immediate, that also tells you what we've been preaching forever. For you to make money in the market, you have to stay in the market. You can't let your emotions dictate policy. You can't let your emotions dictate, what you should do or not do. That's one of the biggest mistakes that people make when it comes to the market. So for example, again, illustrating what we've just seen happen in this year alone, in April, you'd seen your portfolio dropping and you panicked and you said, you know what, I got to get out of the market. I can't be in the market. I've got to move my money because I'm down 20%. You would have missed the 20% rally and you would have missed the market uptick. So now you would have been in the hole. The loss that you thought you had, you would have incurred, and it would have been gone away, and it would have been locked in place. So that's a dynamic that we think is a really good indication of positive momentum when you have a market that's that resilient. One of the other things we see is the market breadth. Now, what does that mean? Well, traditionally, when we've had good markets in the past, you've always been able to isolate that to one area or one sector, right? So technology, real estate, the list goes on and on. But the nice thing about this market is you're seeing this has supported by broad participation. So you've got multiple sectors now that are going in the right direction. And when you have multiple sectors going in the right direction, that prevents the market from having the tendency to correct quickly or to drop or contract or to turn into what we call a bear market. Because it's a lot harder to have those kind of negative cycles in multiple markets across multiple areas. So when you look at the breadth of this market, unlike previous bull markets, this market has a lot of material, has a lot of substance. You've got technology, you've got industrial goods, you've got manufacturing starting to ramp up. All of those things are things that we see as a positive for the market. Now, another thing we see, which we haven't experienced the last couple of years, is stabilization of inflation. I think everyone would agree that the inflation has started to recede, but definitely has stopped growing at the levels it was growing in the last couple of years. So what does that mean to you and I or the market? Well, that means you and I now can budget more efficiently, right? What are my groceries going to cost? Companies can now start to factor, how much is this going to cost me in the next couple of years? So what do I do when it comes to employment? Can I invest more money in the marketplace? Can I invest more money in particular investments in growth, R&D, expansion, etc.? So when you have a stable environment that allows companies and individuals to manage their money, it allows the opportunity for us to take a breath, calm down, relax, and now rededicate towards that growth model. And that's something that is really, really good. Now, when it comes to interest rates, we know the Fed has taken a unique perspective, worrying about the impact of tariffs, but we haven't seen that inflationary pressure come to fruition. What does that mean? Well, a lot of companies had already factored in the cost it might take when those tariffs or those taxes went into place. So their price points already accounted for that. Well, lo and behold, a lot of those tariffs actually never trickled down to the actual goods, meaning the price never adjusted. So now you've got companies that are having more cash on hand, you're having resources dedicated, and they're also starting to forecast into their model the Fed adjusting rates by the end of the year. What is good about that? Well, anybody out there wanting to buy a house? Anybody out there have debt, credit card, otherwise? All of those adjustments on interest rates can have a ripple effect on us. those interest rates can have an impact on our cost, our ability to buy, our ability to loan, our ability to leverage. So you've got a lot of positive things that we're looking for as far as the market in the future. Now, there are some bear environments that you have to be careful of, because we always want to play both sides of the fence, and we want to make sure that, you know, we look at everything. Now, one area that has had an impact on the market is the AI boom. But the question may be, is the AI boom peaked? Has it gotten, you know, the horse out of the gate? Now it's tired and it's going to slow up a little bit. That's a possibility. So there are a lot of other components. The labor market, we're seeing the labor market slowing down a little bit now. What we call job reports, or those individuals that are having job payroll gains, those are starting to see a little bit of a slowdown. So maybe companies aren't hiring as much anymore because they were a little fat, or they felt like they maybe overextended themselves. So you have a couple of things, but overall you see the opportunity there. And this comes back to what we say all the time on this. Make sure you have your team, you have your group of individuals, those people working with you, because without that team, you can make a lot of unwise choices. And unfortunately, you may not know what you don't know. And when it comes to investing, there's potential of growth and there's a potential of loss. And without the right information, you could be into what we call a world of hurt. So make sure you have those individuals around you that are looking at it from different perspectives. They're looking at it from a standpoint of, you know, how am I set up financially? What's the best way for me to invest? What my risk tolerance is? And then use the data that they provide to make those decisions. Because unfortunately what happens is a lot of people don't listen to the data. They listen to their emotions. They get caught up with a situation, and inevitably they make a financial decision that has a negative impact. And what's really ironic about that is a lot of times it's not the market that caused that direction or that correction or caused that loss of money, it's them. Going back to, again, the discussion earlier this year, in April the market dropped nearly 20%. But if you left it alone, in 2 or 3 months later, you were not only 20% back, but you may be up 8, 9, 10%. So you would have had a 30% swing. Now, the market wouldn't have caused that loss unless you got out of it. Unless you let your emotions say, I'm really nervous, I can't lose anything. I have this position or this fund or whatever that we're invested in, and I feel like it's never going to stop going down. The market did what the market does, goes up and goes down. But your decisions, your emotional attachment to the way you think probably had the bigger impact on your rate of return or your growth. And that's going to lead us into our subject today. We wanted to talk about a subject that is really sort of dear to us, the biggest mistakes that entrepreneurs make and how to fix them. And I say that because a lot of our listeners are small business owners or entrepreneurs. They're opening businesses, they're creating models, they're trying to build some wealth. And that wealth is designed around a concept of, I'm going to do it myself. And that's an admirable thing. We've shared this statistic before. 70 to 80% of the U.S. economy is driven by small business. So it's not a small market. But a lot of small businesses fail. Or a lot of small business or entrepreneurs start a business and end up running into some kind of buzzsaw, whether it's litigation, whether it's a consolidation, whether it's the entity just can't fund itself, because of these simple mistakes. So we're going to discuss those, and then we're going to get into a little bit of how we fix them. So the first thing that is the biggest issue with entrepreneurs is they know really good what they do, but they don't know anything else. They have huge gaps in what we call financial literacy. So their ability to understand the finance world or understand the finance vernacular or verbiage, their literacy as it relates to those financial decisions is missing. So you have an entrepreneur who's really good. He builds this incredible widget. Let's just say he builds a widget. It's a great widget, phenomenal widget. But he doesn't know anything about cash flow management. Doesn't know anything about budgeting and forecasting. Doesn't know anything about investing decisions. Doesn't know about securing funding. And so he comes into this world. He's got this great product, but those other aspects are missing. So one or two of these things can have a huge impact. So let's talk a little bit of things like cash flow management. 1/3 of founders believe running out of money contributed to their failure. Now let's think about that. 1/3 of founders, i.e. companies, entrepreneurs, that's 1/3, believe that running out of money is what contributed to their failure. It wasn't customer service. It wasn't the product. It was they didn't have enough cash. So do you understand what cash flow management is? Sounds very simplistic, but it's bizarre how many people don't really grasp that. Budgeting and forecasting is incredibly important when you run a company. People don't necessarily know what they don't know when they start the entity, but as they build it, after a couple more months, they sort of get a framework, right? Do you understand what your payroll may be like? Do you understand what your hard costs may be like? Do you understand what your soft costs may be like? Do you understand what kind of revenue you're going to keep, how long it takes to get paid? All of those are key components that you want to ensure you understand. Otherwise, you're not going to have it. So first and foremost, create a budget. Create a budget. Sit down and say, I'm creating this entity. This is what I'm going to do. Here's what it's going to cost to build it. Here's what it's cost to sell it. Here's what it's going to cost to ship it. Here's what it's going to cost to have employees. And you stick to the budget. If that's the money that has to be spent, that's the money that has to be spent. We don't go above and beyond, and we don't go under that. Another thing is investment decisions. Now, here's a big distinction that most entrepreneurs really have a problem with. They think their personal money should be commingled with their business money, that they're investing in themselves. I hear that all the time. But that's not how you run a company. If you think about it, even though you're an entrepreneur, you are creating a company. Now, can you imagine the CEO of a large company investing his own money, and when they're short on payroll, he pulls money out of his savings account to cover payroll. And then he pulls money out of his checking account to cover payroll. Would he do that? Or would it sound more logical that even if it was his money, he had money segregated, and this money over here is all I have for business and this is all I have for personal. So if I run into a dynamic with business, I have to pivot, I have to adjust, maybe cut back hours, maybe look at pushing more product, whatever that is. But making sure those decisions are not something that is related to your personal growth. Now, that doesn't mean you don't take profits, and you can, if you forecast that, to put back into the business so it grows. And another one is secure funding. Now, most entrepreneurs, when I meet with them, they don't know what a pro forma is. And if you don't know, that's fine. But you want to have a financial plan. You need to take the time to write down, even if it's on a sheet of paper, month 1, month 2, month 3, month 4, month 5. If you do that, what you're doing is you're creating a forecast that allows you to really dictate how you're going to be set up, what's your money going to look like, and then it gives you the ability to secure funding. Again, many entrepreneurs just use their own money, get some money from a family member, and they just take a number. Well, that's not how you run a business. You have to know, what's my number for month 1? What's my number for month 2? What's my number for month 3? And the way to is make sure that you have the funding, as we mentioned earlier, so that your business survives. Now, having inconsistent income will usually result in inconsistent savings. And that's the problem a lot with entrepreneurs. What you'll see with most entrepreneurs, even if they have a level of success, is they'll get to a certain point and they look around and go, I need more money. Or they'll get to a certain point like, man, if I had a couple more bucks. So they end up basically working, instead of working for an employer, now they're simply working for a paycheck. And nobody here wants to open a business and feel like you have to work just, for a money. You want to work for a goal, whatever your mission is. If your mission was to create something to help the world, great. If your mission was to help people, great. If your mission was to be successful in a certain sector, wonderful. That's what should be driving you. If it's just about I have to pay the bills, what's going to happen is that joy is going to dissipate, that creativeness is going to dissipate, and over time what's going to happen is you're just going to lose interest. You're going to feel exhausted and you're going to feel fatigued, just like you did when you worked for an employer. So the first thing we think, you want to make sure that you have some kind of contingency. Now, with our individual investors, we've always recommended having about 3 to 6 months of monthly bills on hand. Now, with entrepreneurs, that number is much bigger. We recommend, once you sit down, you've created your budget, you know roughly what it's going to take to run your operation for month 2, month 3, month 4. You want 6 to 12 months, saved. So this goes back to the first part, where we don't use that profit and just start spending it. Why? Well, if there's a profit, instead of maybe reinventing the expansion, we're putting some of that profit into a savings account for the business. Now, I'm going to say that again, for the business. It's not the personal savings account. So in theory, on paper, you should have a personal savings account with 3 to 6 months of money. That's 3 to 6 months of personal bills. And then you should have a business savings account with 6 to 12 months of business bills. That allows you to withstand the unpredictable nature of business. You can have a great idea, but as we saw with COVID, for example, overnight the supply chain disrupted. You didn't have access to the goods. You couldn't ship out goods. Well, what happened to a lot of companies with that? They didn't have the resources to withstand 6 months to 12 months of nothing. But if you had a business set up, we had that profit margin set up so that the money was going away, it would allow you to now start to build a savings account. Now, a secondary thing you could do is start to create retirement accounts for you as a business owner. Remember, you're going to be looked at just like you work for a company. It is a company. So creating an IRA, 401k, simple IRA, and start putting money into there every month. Now you're pocketing some of the profit. Here's another huge mistake we see with entrepreneurs. They work their tail off, and then what we called, remember we talked about it, lifestyle inflation comes in. So they're making more money, and guess what they do? They spend more money. So now they have as much in their paycheck or much in their bank account as they had before. 30 years goes down the road, they've had this company, but it's been just paycheck to paycheck to paycheck. They have no profit shown, no real growth. Their only hope is that they sell the business to somebody who doesn't look at the under the hood, so to speak, and they make profit on that because they've built no real cash. They've pocketed no real earnings. So again, those are some of the things that I would think are one of the critical things that you have to look at. Another thing is unexpected tax surprises. Remember, you're probably not a CPA. You're probably not a financial planner. You probably haven't sat down with an estate group. You've opened this business, and you just go, well, I put money in, I take money out, and then I do TurboTax, for example, at the end of the year. That wouldn't be the way to run a business. We always recommend that you consult an accountant who understands the industry or the sector, or work with a financial planning team that understands the industry or the sector. So that way you're never surprised. The worst thing that can happen is you get to the end of your first year and you're showing a really good profit, but you get a tax bill of 6 figures. What happens to your company? Well, overnight you're out of business because you didn't plan. So learn about retirement accounts, learn about ways to mitigate tax liability, do some research, invest in accounts that can be tax efficient. That's something else we always talk about. There are a lot of things you can do, and there are a lot of provisions. There's trusts, there's satellite trusts, there's living trusts, there's irrevocable trusts. There are estate planning, unique strategies that can help mitigate or minimize tax liability. There are huge retirement deferred comp plans. I mean, the list goes on. And obviously we'll talk more in other podcasts, but if you don't know about these things, you're hurting yourself. And unfortunately, a lot of people don't take the time, or, no offense, but they'll hop on social media, hear one little buzzword and go down that rabbit hole. But back up, get your team together, talk to your team, ask them the questions you need, share with them what you're thinking of and how you're set up, and let them give you some guidance. Now, the other thing that I see as probably one of the biggest things is the lifestyle inflation issue. So remember, we talked in a couple of episodes about the propensity, as I make more money, I spend more money. But if you remember, I gave you the 50-30-20 rule that we utilized before that were designed for us to mitigate that. So 50% of every dollar goes to our bills, right? 30% goes to our wants. So I've been working really hard. I think I deserve a new suit, or I deserve this. And 20% goes to savings, right? It goes to those savings and debt repayment. So again, what we're going to do is we're going to take that dollar and break it up. So if I'm making another $100,000, I don't take that $100,000 and just blow it on a car or pay the house. I do the 50-30-20 rule. 50% will go to my needs. 30% of that $100,000, for example, might go to something nice, a nice vacation, or I want to upgrade the office. But 20%, which is a huge number, that goes into our savings. That goes into paying down debt. So that way, on paper, we're starting to build some capital. Again, I always say this, unless you have professional advice, you're going to overlook these strategies. You're just going to overlook them. You're going to be caught up in your business. And if you're an owner of a company, and especially if you're an entrepreneur just starting out, you're the marketing guy, you're the finance guy, you're the executive, you're the call center, you're the salesperson, you're the fulfillment, you're the strategy guy. And you're always trying to run and put a positive spin on things. But what can happen is little things left undone can metastasize and grow very quickly. So if you don't have the experience when it comes to contracting, for example, and you're filling out contracts with angel funding groups or venture capital groups or SBA groups, and you don't know the fine print, fast forward 2 or 3 or 4 or 5, 6, 7 years, you might find yourself in a lawsuit where now you're getting hammered and you're being taken advantage of. Or let's say you didn't really understand contracting. You sign these contracts where you're on the knee, on the cuff, so to speak, for a certain amount of financial commitment every month for these contracts, whether it's a lease of equipment or contracting with a landlord, etc. And then the business has an ebb and flow to it, and every month you're still having to stroke a check for $5,000, $6,000, $8,000 because you didn't realize how long the contract was. See, those are the kind of things that you want to make sure that you have in place, because you want to ensure that you understand the whole picture. And again, remember, we use the analogy of watch your six because the premise is when someone's focused on the front and they're looking at one thing, they can't look at anything else. That's why in that world, whether, those type of worlds where you have a dynamic of some kind of risk, the person watching your six is critical. They're protecting you even though you didn't know you need the protection. And that's what we hope to do with this show. Now, the last item I think that's huge when it comes to this is to think like a CFO, not a CEO. A lot of entrepreneurs are used to thinking like a CEO. I'm making decisions. I'm writing contracts. I'm making it happen. I'm creating. I'm promoting. I'm marketing. That's great. But if you think like a CFO, now you're very more detail oriented. So a chief financial officer is going to look at contracts. He's going to look at projected growth. He's going to look at the budget. He's going to look at the checking account. He's going to look at how much is this going to cost, how much that is going to cost. He's less worried about expansion and more worried about organization, right? So if you're going to be that entrepreneur with the next greatest and most successful item that we're all going to want 20 years from now, start out as a CFO. Don't start as a CEO. Start out doing your pro forma. Start out sitting down, even with a sheet of paper, and writing out a rough budget of what all these things are going to cost. Write roughly what you think they'll sell for, who you'll sell them to, what your market share looks like. Write out how much you'd want to save every month. Write out, what are the tax benefits in that particular sector, and if I don't know them, how do I get them? Write those things. Take those thoughts, put pen to paper, and make sure you have the details. And if you do that, you're going to be in a scenario that a lot of entrepreneurs have not been in, unfortunately. You're going to be successful. You're going to succeed. I don't care what the strategy is. I don't care what the sector is. The fundamental flaws are always the same. So we hope you enjoyed that. We hope if you're in entrepreneur space or in that self-employment space, again, doesn't matter what sector, doesn't matter what industry, these are redundant issues that if you do them and you address them, it's going to probably lead to your success. So now we're going to do like we always do. We're going to turn over and we're going to take a look at our DMs. We've got some DMs that we're going to be looking at, and we're going to answer those questions for you here on air. All right, we're going to go to our in-house producer, Grady, and we've got some DMs. So what do you got, Grady?
Haven't heard of tariff fear in a little while. What's up with that? Where did it go?
So short answer, the tariff fear was miscalculated and probably over-calculated or exaggerated, and we haven't seen it come to fruition. That's the short answer. What was going to happen, many smart people said was going to happen, didn't happen. Now, the long answer to that is that the tariff fear was that when that came through, there'd be many people call it a tax, but there'd be an increase of cost on goods. So if we're ordering, goods from Europe, ordering goods from China, all these countries are going to increase the cost of goods 15, 20, 40%. And you can imagine the financial impact that would have on you if you went to buy something, it's 50% more. But what did happen was because of the art of negotiation, our government was successful in getting these contracts with these other entities, and many of them we deal with. For example, Europe was one that just happened, signed, sealed, and delivered before any of those price hikes went through. Therefore, the cost of goods never expanded. So, for example, we just had a huge signing with the EU, I want to say a day ago, 2 days ago, where the tariff rate dropped to 15%. Not only that, but now the cost of goods for U.S. products are going to be more robust because now the cost to go to Europe is cheaper. So what does that do? Well, that builds our manufacturing, particularly for entities and products made in the United States. So while the tariff fear seemed like a possibility, it always was the possibility that if it reverted and turned around quickly, and negotiations handled quickly, it actually could help our economy and help our growth and build a more robust economy, and that's really what's happening. So now it's not fear anymore, which is why you don't hear about it on the news and no one's talking about it because there's nothing to sell. Good question, though. Hope that answered it.
He says Lockheed, Northrop, and L3 have outperformed all my other stocks I hold. Should I dump more into defense?
So that's a really good question, and that's what you call tactical allocation. We're not going to give you advice on that because we don't know other parts of your investments. We don't know how old you are. We don't know what your investment tolerance is. Remember, when you invest or make a decision, you have to have other factors, not just about the stock. It's about your age, when you're going to use the money, how much cash you have on hand. Now, the long answer of that would be ensuring that you sit down with a financial planning team, if you have one, give them the information you're describing, and they should, if they're any good, are going to do what we call a suitability evaluation. They're going to say, what's suitable for this situation? Does this person have enough cash to withstand the market correction? Then their investment advice should fit and give you the direction you want for the sectors you're talking about. So that's a unique way of looking at investing. We call it tactical, but you want to make sure these other variables are watched because they have a huge impact. But hopefully that gave you some guidance. What else you got, Grady?
Emily from Facebook says the used car market is a huge bubble that's bursting, and my friend told me it's the best time to buy a car. Is this true?
So the used car market, especially with the inflationary pressure after COVID and the distribution disruption, was a huge market with incredible spreads. I mean, anybody tried to buy a used car, back then you were paying almost more than a new car. That has been not the case recently. And with costs continually drop, the opportunity now is to purchase vehicles possibly, or depending on the make, model, and area. But again, some of the factors that go into this are unique to where do you live, what type of currency are you using to purchase the vehicles. I know it's hard to think about, but we've got people watch us all over the world, right? So they may use different currencies, exchange rates can impact. And then the type of vehicle. The area that you're looking at, are those kind of vehicles more common? I think the opportunity's there. We do see that in used car pricing. But again, there are other variables that you want to consider. Should you lease? Should you buy? Should you pay it all off? A lot of times people want to buy something right away and put cash on it. That may not be the best way if you're a business owner. So I would say cost of goods are dropping in certain areas like the used car market. But I would also say if you buy it versus lease or rent or sell, is really contingent on what kind of scenario you're in, if you're a business owner, self-employed. So feel free to DM us and we'll give you some more information. Good question, Grady. What else we have?
This one lines up with your monologue today. We got an entrepreneur here DMing us. As an entrepreneur, sometimes I make a ton of money monthly. Sometimes I make almost no money. How do I safely manage those large fluctuating amounts?
So that goes back into our conversation earlier about think like a CFO, not a CEO. If you are aggressively, every dollar coming out of your pocket, you're putting 20% away or 30% into this savings account for business. Your goal is to get that savings account up to 6 to 12 months. Remember, 6 to 12, not 3 to 6. If you have 6 to 12 months, your company should not have 6 to 12 months interruption of revenue. If it did, it's not a successful company. You probably should close it. But if you do have ebb and flows, and you've got 6 to 12 months, you'll have that cash to plug in. So I think the first thing is make sure you work aggressively on getting that 6 to 12 month savings account, even if it does well. If you have a good month and you just knock it out of the park, same thing, 20, 30% goes in the savings account. You have a crappy month, well, that following month that you saved, you could use it to float it. But that's the critical part because again, remember we talked about earlier, a lot of companies, over a third, say that they went out of business because they didn't have enough cash. That's the thing you need. That's what that 6 to 12 month is for. It's for irregular cash flow, to maintain payroll, and to feel like you're not chasing paychecks. But it's hard. It takes discipline. Anyway, hope those questions were answered well. We appreciate all the DMs. We hope to see you next week here on Watch Your Six. I'm Jason Edwards, and have a great week.